Today. My name is Jason Krausert. I'm really glad that you're able to join us today. It's a beautiful fall morning here in Calgary. We had a bit of a cooler weather last week, but it's warmed up again, so we get a little bit of a warmer fall. So that's really great. So hope the same as where you're at. So today we're going to talk about something that I have a fair amount of experience in personally and professionally, and that's on different options for repaying your debt. What I call kind of the debt repayment grab bag. We're going to look at 8 options for repaying your debt. We're going to look at kind of at a high level overview. I can get into a lot of detail on all of these, so I'll probably do that in future lives or in future offerings, but I wanted to just kind of give you a broad overview of what these options are, just so you can kind of have those available. Just before I do that, I'm just going to share this with a couple of my other groups. Just to invite a few more people on. So if you can just bear with me for a moment as I do that. Just take 2 shakes here. So yeah, there's often a lot more options than people think when it comes to repaying debts. So I'm just going to go over those in this talk for again, to give you kind of a high level overview of what those options are. So just need another few seconds here. Boom, just like that. Okay, so my name is Jason Krausert. I'm the founder of More Life from Your Money. I'm a financial wellness coach and debt counselor, and I've worked with close to 1,500 clients one-on-one to help move them towards the freedom and peace of mind that comes from being debt-free and savings rich. Now I'm focusing mostly on people kind of 45 plus aiming for retirement and wanting to make sure they have a solid strategy for being debt free and having the money that they want to live the retirement that they dream of. So we're going to talk about one element of that today, and kind of like I said, a high level. It's being how to reduce debt or different options for reducing your debt. So this is an important topic. Obviously debt can be stressful. So it's a understanding what your options are can give you some peace of mind, I think, and obviously repaying the debt itself can give you some peace of mind around what's available to you and what steps you can take. Depending on what options you pick, they could help to save you money on repaying the debt. So it's important to know what your options are. And once you've got the debt repaid, you've got a lot more freedom in life. You'll have more money spared up, and that'll free up. You'll be able to free up your finances, and it'll also have you feel freer in life. So it's really important. So I hope you get some value here. Hi, Bernadette. Okay, so what I'm going to do is I'm just going to go through the 8 options, and I'm going to talk a little bit about what each option is. Okay, so how it works and what it is, what sort of credit impact, if any, there is with that option, and also give you a brief idea of who should consider these options. Now, as far as who should consider these options, it's hard to summarize that in a few sentences. So the best way to really understand what option is best for you is to do your research. If you want clarification on anything, talk to a debt professional. Could be someone at your bank, could be a debt counselor, could be an insolvency trustee or a bankruptcy trustee. Could be your accountant may have different options. I mean, for most people, the options we're going to talk about won't be bankruptcy, consumer proposals, those sorts of things that can have a negative effect on your credit and that sort of thing. But those are important options for people that are in a difficult situation. So we're going to review those. But sometimes people think, okay, I can't repay my debt, so the first next step is bankruptcy, and that's just not the case. There's several other options in between that you can look at. So we're going to talk about those briefly. Okay, so number 1, managing your budget. So this is what I recommend for everybody. So managing your budget just means looking for ways to increase income or reduce expenses to free up money so you can put more money towards the debt. So that could look like part-time work, could look like more hours at your current job, could look like overtime. It could look like Hi, Daryl. Could look like part-time or self-employment, taking on a side job. Maybe you've got a hobby or an interest that you've been wanting to pursue. You could do that as a side business. If you're older and you're looking at those various pensions and social safety nets that are available out there. Now, I should just preface a lot of what I'm going to say in this live is from the Canadian perspective. I'm not as familiar with American laws and regulations and what's available in terms of repaying debts, because there will be some variance between Canada and the U.S. So most of what I say will be focused on Canada, though it would have some broad applicability to the U.S. as well. So that's managing the budget. That's the income side. And then the expense side, just looking for ways to trim back on your costs, starting with things that are optional or flexible. That's eating out, entertainment, recreation, sports, gifts, clothing, those sorts of things that you have some flexibility on. Those are things where you could start looking to reduce some expenses. Other areas where you don't have quite so much flexibility could be things like your cell phone. When your contract's up, see if you can go with a different provider that can lower your rates. Same with car insurance, utilities, those sorts of things. Can you adjust the packages that you have to lower your expenses? Those sorts of things are also areas where you can look to trim back on costs. Of course, where you're living, you can look at lower rent and stuff. That's a little less flexibility there, but there are ways that you can reduce expenses in order to free up the money to put towards your debt. So that's number one, managing the budget. That's something I recommend for everybody. No credit impact on that, of course, and everybody should be managing their budget to make sure their income's higher than their expenses, and they're putting that money towards what's important to them, whether it be debt or the other things. Number two, refinancing. So usually when we're talking about refinancing, we're talking about refinancing on things like mortgages, where you would, when you're renewing your mortgage, you could renegotiate to roll the existing debt into your mortgage. So let's say you've got a mortgage at 3 or 4%, credit cards at 15 or 20%. It's obviously going to save you some money, or it's just going to lower your interest rate if you can roll those credit cards into your mortgage. Whether or not it actually saves you money, well, it depends how long it's going to take to pay off your mortgage and that sort of thing. But it will certainly take some pressure off in terms of paying those high interest rates and those high credit card payments today. So another option around refinancing is a home equity line of credit, where you get a line of credit that's secured by your house. As you pay towards the mortgage, the line of credit, the availability in the line of credit goes up. So these are that's considered quite a mature form of credit, but it can be quite helpful. Those are things you can talk to your bank about, and again, you do have to go through a normal credit application process for those. So it is important that you have good credit, and you plan a little bit in advance of that by pulling your credit report and that sort of thing. So you have an idea of what the bank will be looking at when they pull your report to be applying for those sorts of things. The credit impact on that is negligible as long as your payments are up to date. Who could consider that? Obviously, you need to be a homeowner to consider that. If you've got good credit, that will allow you to increase the amount in your mortgage or home equity line of credit. You need to have at least 20% of your mortgage paid off, or at least, or the equity you should have at least 80%, the amount of the outstanding debt should be no more than 80% of the value of your house in order to qualify. At least in Canada, those are the guidelines to qualify for that sort of refinancing. Consolidation loan. Consolidation loan is number 3. So we've talked about managing your budget, refinancing mortgages, and now a consolidation loan. A consolidation loan is where you would apply to your bank to get a lump sum of money that you'd use to pay off your credit cards and other debts. And then you make a payment each month to the bank to pay off that lump sum. Some banks will require that you close anything that you've used to pay off or anything that you've paid off with the consolidation loan. So let's say you get $10,000 and you've paid off 2 credit cards with that. Some banks will require that you close those 2 credit cards. The thing to remember there is that if the bank doesn't require that you close those credit cards and you pay them off, that means that you've got 2 empty credit cards sitting there. Now, the trick here is not to use those credit cards again. That will then essentially increase your overall debt level. So let me just reword that. Prior to the consolidation loan, let's say I'm just using an example, you have 2 credit cards with a total value or a total limit of $10,000 or balances owing of $10,000. You get a consolidation loan for $10,000 and you pay off those credit cards. Those credit cards now have 0 balance, but a $10,000 limit. So now you've got a $10,000 loan and $10,000 available on your credit cards. If you then go back and use those credit cards, let's say you max them out, now you've got all of a sudden $20,000 in debt rather than the $10,000 that you had with the credit cards. So what I recommend is if you get a consolidation loan, pay off what you're going to pay off with the loan. It may not cover all of your debt, but pay off what you can, and then close the items that you paid off using the loan. Just the safest way to prevent yourself actually getting into a little more deeper debt situation. Again, credit impact. As long as your payments are up to date on a consolidation loan, it won't have any negative effect on your credit rating, which is your payment history on the debt. It might have a little minor negative effect on your credit score. That's the number between 300 and 900 again in Canada. That is sort of the overall view of your credit. It may have a little negative effect on that because often a consolidation loan is viewed as a loan that someone needs when they're having some trouble. But if the benefit of the loan, meaning it can lower your interest rate and lower your monthly payment, outweighs that credit impact, in most cases, the credit impact is relatively small. Who should consider this? I think it should be considered by people who, with their current loan debt structure, are not able to make their minimum payments. They're able to make payments, or they're not able, but it's becoming difficult. Hopefully with a consolidation loan, you can lower your overall monthly payments. Hopefully, that will take some pressure off your budget. So that can help to make it easier to pay the debt, which is in your interest and in the bank's as well. So that's number 3. Number 4, friends or family. It's always an option to borrow from friends or family to pay off debt. That can hopefully be paying a lower interest rate or maybe no interest in that situation and have more flexible repayment terms if you're repaying your friend or family. There's some really important things you need to be aware of there. The relationship is number 1. You don't want borrowing money to come in between you and people that you love. So it's really important that if you borrow from friends or family, to make sure that you have clearly understood and clearly outlined what the terms of repayment are. In some cases, they may not even want you to repay. Your friend or family says, you know what, don't worry about it. I'm not expecting the money to be repaid. Just deal with whatever you're dealing with and let's move on. In other cases, they will want it to be repaid. In that case, it's really important. And what I recommend is actually writing it down. What will the interest rate be, if any? What are the payment terms? How much, in other words, how much do you expect me to repay every month? When should the full balance be repaid? Just like you would with a bank, the same information that you would with a bank. And each of you have a copy of that so that a year or 2 from now, there's no question about what's expected of both of you, because that's what's going to get in the way of your relationship. And so it's really important that you protect the relationship first. But if you're able to do that, then those are viable. It's a viable option for repaying some loan at a lower interest rate and lower, hopefully lower cost to you on a monthly basis to give you more flexibility. Okay, so that's managing your budget, refinancing mortgages, consolidation loan, and friends and family. So it's first 4. Number 5. Number 5 kind of has 2 parts. So I'll talk about them together but separate, if that makes sense. A settlement is and of course, backing up a second, friends and family, no credit impact. Who should consider this? If you have a good relationship with your family. If the debt is just too difficult to pay. This is something that students will often do. They'll often get support from friends or family so they can get off on an easier foot in terms of having debt, student loans, that sort of thing paid off. If you're in a difficult situation, for instance, maybe you've lost your job or there's a health issue that's preventing you from working, then often people will ask friends and family for support. That can also come in the form of covering expenses and looking after kids and to free up so you don't have to worry about childcare costs and that sort of thing. So support from friends and family can come in a lot of different formats. It can be borrowing money. They can cover expenses for you. They can cover some responsibilities for you that allow you to work more, to make more money. So those are some options. So number 5, settlement. A settlement is where you go to your creditor and you offer to pay a smaller percentage of the balance. So let's say you have $10,000 only on a credit card. You go to your creditor and you say, I'll pay you back $4,000. If the creditor accepts that, they will close your account. And they will expect that payment usually fairly quickly, usually within 3 months. Now, banks generally will not consider a settlement unless the debt is in collections. Okay, so this isn't just something you can just go into your bank and offer to pay off a smaller percentage of the debt. Usually the debt has to be in collections. In that case, the bank is often going to be more open to getting a smaller percentage of the debt than getting nothing at all. If it just ensures that they'll be getting a certain percentage of the debt, so they could be open to that. Now, a settlement, so the benefits of a settlement is it could save you money. The negative is that it does affect your credit. So the credit rating system in Canada is a 9-point scale. R1 means that your debts are being paid on time. R9 means that it's, it could be a bankruptcy, a collection, debts written off, that sort of thing. A settlement is an R9. So a settlement is an R9 for 6 years from the date you pay it off in Canada. So if you go in tomorrow, pay off a debt through a settlement, it's on your credit for 6 years after that, and it will be very difficult to get any credit for at least 2 years after you've paid off that loan through a settlement. Just making sure I covered everything there. So who should consider this? Again, debts that are in collections, that you're not able to pay off, that you just don't have the funds to pay off whatever the collection agency is requesting. Collections debt is already in R9 in most cases, so a settlement isn't a huge drop from where that debt already is. So it could make a difference for some people. So that's a settlement. So it's important it's another option to keep in mind. Now, another option that I kind of put under the negotiation umbrella is reducing your interest rates. Okay, so this is something that anybody can apply for. You don't have to be in collections. You don't have to be behind on anything necessarily. You would just, anybody can apply to a bank to have their interest rates reduced. So for instance, you have a 20% interest rate on your credit card, you can go to the bank and you can either ask them to reduce the interest rate, and they may be open to it if you've been a good client. All banks will have a lower interest rate credit card that you could apply for, and then transfer your balance from the higher interest rate card to the lower interest rate card. The lower interest rate cards are often in the 10 to 13% range. So that can obviously mean that if you have a lower interest rate and you continue putting the same payment onto the card as you were at the higher interest rate, it'll pay off the debt faster and less expensively. So yeah, so that would be number 5 and 5A, I guess you could say, would be a settlement or a negotiation. So negotiation, when you reduce your interest rate, it doesn't affect your credit as long as your payments are maintained and are up to date. Who should consider this? Again, anybody that has debt, that you're in good standing with your bank, that you have an interest rate that's quite high, it's in the 19-20% range, and you want to see about reducing that down to a 10 to 13% range to save some money. Okay, so those are things that I kind of put, those 5, so managing your debt, refinancing, consolidation loans, friends and family, and settlements or negotiations, are what I call do-it-yourself options. So these are things that you would put into place on your own. You go down to your bank, you talk to a friend or family, or just sit down at your computer and do up a new budget, or those are things that you put into place on your own. There's three other options that I call legislated options. So these are things that are created by the federal government in Canada, in the U.S. there's probably some differences, but there would also be a couple of these, at least in the U.S. So these are things that are in Canada are created under the Bankruptcy and Insolvency Act. Now, only one of them is bankruptcy, but the Act creates three debt repayment options that are regulated by the federal government and the provinces. So I'm just going to go through those really quickly. In the first option, the first level of debt repayment through a legislated program is called orderly payment of debts. Now, this is something that's not, of these three, this is probably the least well-known across Canada. In my province of Alberta, it's fairly popular or fairly well-known by comparison. The program was set up by the federal government, and each province has the option of making it available to their people. At present, it's only available in 4 provinces. So that's Alberta, Saskatchewan, Prince Edward Island, and Nova Scotia are the only 4 provinces that make orderly payment of debts available to their people. This is a program for people who can afford to pay the debt. Okay, so they've got money to repay the debt, because on orderly payment of debts, you have to pay the full balance of the debt. So you can afford to pay the debt, but it's difficult under the current terms. So if you've got 20% interest rates and or payday loans or whatnot, and you can't meet the current terms, but you do have means to make to pay the full debt at an adjusted terms, then orderly payment of debts would be that first level of federal repayment assistance that could help. So how orderly payment of debts work is clients would make a monthly payment into a trust account. That payment is distributed by the administering body to your creditors every month. You would pay 100% of the balances owing. Your interest rates would go down to 5%. It's on your credit report. It's called an R7 rating as a consolidation order. So it's an R7 for the payment period, so for how long it takes to pay off the debt. And in Alberta, it's on your credit for 2 years after that. In the rest of the provinces, it's 3 years after that. Okay, so it's on your credit for payment for the payment period plus 2 or 3 years, depending on where you live. So when you go on orderly payment of debts, any debts that go on the program are closed. You won't have any more access to those debts, and you won't have any access to credit until everything's paid off. Okay, so it is a fairly significant credit impact. Who is it for? Again, it's for people who are able to pay the debts, so they have money to pay the debts, but they just can't. Meeting the current terms is just too difficult. So on orderly payment of debts, the interest rate is reduced, and in some cases, the actual payment amount would be reduced compared to paying the debt separately. So that can make it easier for you. But there is the credit impact that you have to consider. Orderly payment of debts you can include taxes on that, income taxes. It's only for unsecured debt, however. So it doesn't include car loans or mortgages. It's just for like credit cards, lines of credit, student loans, taxes, payday loans, overdraft on your bank account, those sorts of things that have no collateral on them. Okay, so that's orderly payment of debts. The second legislated debt repayment program is more popular. It's probably more, you probably heard the term, a consumer proposal. Now this is, you'd have to meet with an insolvency trustee to do this. A consumer proposal or an insolvency trustee is a federally licensed individual. They work in private companies, so these are for-profit companies. And basically how the consumer proposal works is, in most cases, the trustee will create a proposal that reduces the amount of debt that you owe. It will reduce your interest rate to 0. If the creditors approve the proposal, you would pay the proposal out over a maximum of 5 years. Again, OPD is also a maximum of 5 years, unless you have student loans, and it can go beyond that. But for both, but otherwise for both an OPD and or orderly payment of debts and a consumer proposal, the maximum repayment term is 5 years. Excuse me. And again, on a consumer proposal, anything going on in the program is closed, and then no access to new credit until everything's paid off. On a consumer proposal, the the credit impact is that it's on your credit for the payment period plus 3 years. So it's the same as an orderly payment of debts in all provinces except Alberta, where an orderly payment of debt is only 2 years after you pay it off. Consumer proposal does not include student loans unless they're 7 years old. So that's important to keep in mind. You're not required to make payments on the student loan in Canada while your other debts are on a proposal, but interest still continues to build on a proposal. Now, I know there's a lot of information here that I'm throwing at you. Hi, Heather. But you can search Consumer Proposal Canada or US online, and they'll give you you'll have lots of information where this will be summarized as well. So, so that's a good way to just kind of get everything in writing. I'll probably be producing some sort of summary of this in the future that I can make available, but there's lots of information online as well. So that's consumer proposal. So just in summary, so far we've talked about 7 debt repayment options. One is just managing the budget, refinancing mortgages, consolidation loans, friends or family, settlements. Then from a legislative perspective in Canada, there's an orderly payment of debt program, and there's consumer proposals. And the last option is, of course, bankruptcy. So a bankruptcy is for individuals who can pay either little, if any, of the debt. You have to be insolvent to qualify for a bankruptcy, which means that the amount of the debt and your payments outstrips your assets. You don't have the ability to repay that. There's just not enough funds are available to repay the debts. There's a lot of misunderstandings about bankruptcies. In Canada, you do not automatically lose your assets in a bankruptcy. There is the risk of that depending on your situation, but most trustees will try to factor those assets into your repayment plan, but you don't automatically lose them. So when I talk about a repayment plan on a bankruptcy, what I mean is that when you go on a bankruptcy, you're under bankruptcy protection in Canada for either 9 or 21 months, depending on your income. During that period, creditors, you have protection, court protection from the creditors, just like you do on consumer proposal and orderly payment of debts. In a bankruptcy, there are certain thresholds. So you're allowed to have a certain level of assets. And so for instance, in a home, you're allowed to have $40,000 in equity. If you have more than $40,000 in equity, then the trustee will try to roll that or try to have that excess equity paid out to the creditors through monthly payments while you're on the program, while you're on a bankruptcy. So they'll try to arrange it so you don't lose assets, that instead those assets become a monthly payment that you'll make to the creditor while you're under bankruptcy protection. After you've met all the conditions of the bankruptcy, at the end of that 9 or 21 month period, the bankruptcy is discharged, meaning all the debts are basically waived or forgiven, and then you're debt free, and it's on your credit report as an R9 for 6 more years. Okay, and again, it will be very difficult getting any credit for most of that period. You could get a secured credit card if you did need a credit card to start rebuilding credit. But it'd be very difficult to get additional credit, not impossible, but more difficult, more conditions attached and whatnot. Oh yeah, and I was talking about a couple of myths around bankruptcy. Again, you don't automatically lose your assets in Canada. I'm not 100% sure about the regulations in the US on this, so you need to look into that. Or if anyone has any information, please put it in the comment box. I'd love to know and share that with others. Excuse me. And bankruptcies are no longer published in the media. So if you declare bankruptcy, my understanding is it used to be published in the media. They don't do that anymore. So you don't have to worry about your privacy or confidentiality in that regard. So again, I know that's a lot of information to be throwing at you. So just basically in summary, those 7 options that we talked about are managing your debt, or 8 options rather, managing your debt, refinancing mortgages, consolidation loans, getting help from friends or family, a settlement or a negotiation with your creditors, an orderly payment of debt program if you live in Alberta, Saskatchewan, Prince Edward Island, or Nova Scotia, a consumer proposal, or a bankruptcy. And there is one other option that that some people can look into. It's called, in Canada, we call it voluntary credit counseling. And I know this is available in the US as well. Maybe different rules and regulations around it, but it is available in both countries. And that's basically where you go to a company, credit counseling company, and they will often try to make a settlement offer to your creditors to reduce the amount of debt owing. And then if it's accepted by the creditors, then you would make that payment to the creditors over a specified term until it's paid off. There's the benefits of those programs are that they have more flexibility in terms of which debts they can put on the program. Under orderly payment of debt and consumer proposal, you have to put all unsecured debt on the program. With a voluntary credit counseling, you can pick and choose a bit. But with voluntary credit counseling, it's and there's the other benefit. You have more flexibility. Plus, you could have lower payments than by making the debt payments on your own. On the negatives, I guess you could say, that you need to be aware of is that some voluntary credit counselors will recommend that you let the debt go into collections before you apply, because that will make the creditor more open to a reduced payment amount. So there is a risk there. If you just don't pay and you let it go into collections, then there's other things that creditors can do to force you to pay. Also, voluntary credit counseling is voluntary, meaning there's nothing legally binding the creditors or you, requiring you to stay to continue on those programs. So a creditor or yourself can opt out of that agreement whenever you like. Which for yourself, or which, if a creditor does that, it obviously puts you in a difficult position. If they say, we're not going to go by those agreements anymore, we require full payment right away. That can make it difficult for you. But it does work for some people. So you have to, again, look at your own situation, talk to the different resources that you have available in terms of credit counselors, your banks, accountants, etc., and come to the solution that's going to be best for you. Okay, so I guess that's 9 options for paying off your debt. Again, all of that information, there's lots of information available online about those different options. So feel free to do that research. So I guess by way of homework, if you will, that's one thing I'd recommend, that if you are looking for options for paying off your debt, I would get online, do some research. Feel free to put any questions that you have in the comment box under the video, and I'll try to get to those as soon as I possibly can, and give you some of my own experience with that, and give you some guidance. One of the most important things I would recommend is that if you are struggling with debt, don't wait to get it handled. If you're in a situation, maybe you've lost your job, maybe there's health issues that's preventing you from working, or maybe it's just becoming too much, don't wait. A lot of times, either through fear or not knowing what's available, we wait until things become too difficult, and then we're forced to act. And that's especially true when you lose a job or something like that, when people look at, I'll be back to work in a month, so they don't worry about it. They just start putting all their expenses on their credit cards and stuff. They'll pay it off when I'm back to work. In Alberta, with the drop in oil prices, we've had a lot of people have been out of work, and they've been out of work for over a year, even 2 years. And they had money available that they just used it all to pay off their expenses, and now then that's when they come to meet, because they no longer they don't have any more credit left. They don't have a job yet. So it's kind of an extreme situation. But my recommendation is that if you have a health issue that prevents you from working, if you lose your job, if you're just feeling overwhelmed by your debt situation, get help sooner rather than later. That's where you get your options. That's where more of these options come into play. If you leave it too long, you'll eliminate some of these options, and then you will be limiting what you have access to. So get help as soon as you can, get some advice, and make a decision that's best for you as soon as you can. And again, like I said earlier, don't assume that bankruptcy is your only option. I think that's some people think, is that when they get into trouble, my only option is bankruptcy. So of course they don't go into that very, very openly. But when you go up and get the information, and as we talked about here, you see that you've got a range of different options well before bankruptcy. So again, look into those options and find the one that's going to work best for you. Please leave your comments and questions below. I'll do my best to answer those as quickly as I can. If you, I'm here every Wednesday morning at 9 a.m. for Wealth Wednesday, and the whole point of these talks are to give you some tips and insights and hopefully some inspiration to develop your own finances, to have a healthy financial situation now and leading into retirement. And so hope you'll join me every week. If you want to get notifications of these events, one way to do that is to go to my private Facebook group, Rock Your Retirement 101, and ask to join, and I'll approve that. And then once it's approved, you can go in the notifications tab and indicate how you want to be notified of these lives, and then you'll get notifications as they are being done. So, like I always say, you don't have to see the whole journey in order to move forward towards whatever your goals are, whether they be debt repayment, retirement planning, paying for your kids' education, paying for that next holiday, getting a new car, whatever it is, buying a house. You don't need to see the whole journey. Just know what your next step is and take it. And then the next steps will become visible after that. So just take the next step, and I'll see you next Wednesday. Bye-bye.